October 24th, 2023. Today, we pretty much only got a measured move down of the opening range. We didn't quite test the exact measured move, which was around this close too, which probably could have gotten tested for sure, but we were about a point short. Some traders would argue that since this was a double bottom and then we rallied from here, the bull move started here. And, if you use that measured move down, you get pretty much the exact low of the day. Um, but I don't think it really matters. I think either way, using this one or using that one, regardless, you have to get out if you're short above bar 42. So maybe you take a little bit, you get a little bit extra if you use that measured move. But I think in general, you're probably going to want to use the measured move from 17 open to the one open because it's just a lot more predictable. Good bull bar on one, closing near its high. Yesterday we had a big buy vacuum on bar 42, and it's noticeable that it had not gotten tested yet during any of these rallies. So it makes me think we might have to get to this close. Bad follow through on two, though. Some traders bought above one, hoping that we were going to get vacuumed up to this close and they were going to be able to make a quick scalp. And two is disappointing. When two is disappointing, a lot of those traders who are buying for any reason are exiting during three. That's why when we start to rally into those prices that traders are buying, it starts to sell off. Once you get three, any bulls who held through two, it's probably okay to hold through two, but you probably have to have a wide stop and be willing to scale in for, this reason. It's probably okay to hold during two, but the problem is even if you get a big bull bar that looks like one after two, it's one pullback two. So it's a two-legged move and potentially a bull trap. So a lot of traders, when they see two, they start to sell out, and that's causing three. And then a lot of traders who are still holding, when they see three, they're really disappointed in three. They were hoping for at least a bull body, and so they'll just flatten at the market, and that's what's causing the sell-off on four is bulls who are buying it up in here, disappointed in the close of three, thinking we are now at the top of the trading range, selling out at the market, causing four. Probably buyers below one, though, and you got to keep in mind the bulls who bought below three are probably going to be able to get out at break even. So, when you see four, it's disappointing for the bulls, but you have to keep in mind that traders are probably going to be willing to scale in below one, and they're probably going to make money. Five, it's a double bottom with one. It's a potential swing buy, but tail on the top, it's not quite as big. I think it's a reasonable buy above five, but you need ideal follow through if you're buying above five, and you get ideal follow through on six, or basically ideal follow through. Six is a big, strong bull bar closing near its high, but the problem is that it could be a second leg trap, one, pullback, two, and that it didn't really break out of anything. If six closes above the high of two, it's probably a better buy for a swing, but it doesn't close above that high. So a lot of traders are disappointed. And something else to keep in mind is you don't really have trap bears. You might have trap bears who sold above five, so that's one set of trap bears. But if you notice, bar four, the close of it, after bar five, if you sell the close of four, you're disappointed on bar five, right? So if you sold the close of four, a lot of traders might be worried they're about to have to exit above five and they're going to take a big loss and the market's just going to rally. And they're worried about taking a big loss. So they're going to have to exit above five. And as the market's rallying up, they're going to panic out. But you can see the tail of six tested down to the close of four. So when the tail of six tested down to the close of four, it let out the traders who sold this close and were disappointed in this. And if you sold this close, we're disappointed in this, and you get out here, that buying, those bears buying back shorts is causing this rally. Some bulls might take the buy above five. Sorry, I started a little early. But some bulls might take the buy above five. But, I think this is more short covering, and it doesn't break out of anything. So there's more risk that it's a trap. It's potentially always in long on six, but I don't think it's, if you're going to buy, you need to buy small with a stop below five. And a lot of times trades will, in trading ranges, they're going to run bad stops. Like a bad stop is below six. If you're buying, your stop needs to be below the low of the day. And so you can see it traps bulls in, and you get this big bear bar on seven, potentially trapping bulls out who had weak stops. And then you get a rally up on eight. And eight is interesting because, it's now a double bottom. It's a big bull bar. Some traders would argue it's always in long and that we're going to rally to at least the 42 close. But if you bought the close of six and you saw seven, what are you thinking now during eight? Thinking, well, this is obviously not what I wanted. When you bought six, you did not want to see seven. That was a huge disappointment. Now you got eight, and this just feels like a gift. It feels like a gift to get out around break even. And that's what traders do on eight. They get out around break even, and that's what causes part of the sell-off on nine. Additionally, nine broke out above the two high by one tick, and it wasn't able to sustain the breakout. if 9 is good follow through for the bulls and we end up getting a big bull bar closing near its high, then I think it's reasonable to buy that. But we don't get it. We get bad follow through on 9. Bulls who are buying 8, disappointed 9, a lot of them will exit on the close of 9, and that causes this big bar on 10. I did think, by the way, I thought it was just interesting. I'll wear 10. Hold on. Just put this here so I don't forget. I was thinking when we were in here, I did buy above 59 today, and we got 60, which is good follow through, and we started to get good follow through on 61, but it started to sell off, and I was kind of thinking, like, what magnets could we possibly be going for right now, right? Because when you're in a trading range day, you're going to get vacuum tests of magnets, like this low, right? So this low is a magnet because bulls bought below and they're disappointed in these. They'll buy below because it's a bad sell signal bar. It's a doji bar. And then we get a vacuum test up of that low. And so it does that kind of thing a lot on trading range days. And so when you're buying in a trading range day, you should probably have a magnet you're looking for. Like initially when I bought the 59 close, I saw the magnet of the 30 close. I thought, well, we'll probably get to at least the 30 close. And when we started to rally on 61, I was thinking, well, how high is this going to go? What do we need to test? What needs to get tested? And I was thinking, it's potentially possible we get to the high of the day, but I didn't think the high of the day was a super important magnet. I actually thought the open of the day was a more important magnet, which makes buying above 59 not quite as good because you're buying a breakout of a tight trading range around the open of the day on what's probably a trading range day. But I thought it was potentially possible we would have to get to the high of the day. I was out of my position up in here, so I'm not obviously not holding for any of this, but I thought I just think it's interesting that 79 went to the high of the day, confirming that was a magnet bulls were looking for. But occasionally at the end of the day, you just get big moves, and you're just never going to be a part of them. It's not a good idea to try and trade them. I'll be interested to see if we actually sell off right here back to the open of the day. That'd be kind of funny because it is a trading range day, and so that stuff will happen. It probably won't happen with how big this move is. It's probably just going to be very sideways for the last bar or two. But that would be interesting if it got back to the open of the day. So anyways, follow through on 10 for the bears, but it's mostly from bulls who bought above here, disappointed in 9, selling out of their longs, causing 10. 11, big outside up bar. It's potentially 3 pushes up, but it's early in the day and it is a bull breakout. So, it's potentially okay to buy above 11, but you got to be careful because you're nearing a magnet. And that's exactly the problem with buying 12. I think you can buy 12, but look where you're buying. You're buying right at this close. You're buying this test of this, the high of this trading range. So if you're buying, you need to be quick to make decisions. And when you get bad follow through on 13, a lot of those traders who bought above 12 are going to be disappointed in 13, and they're going to get out around break even during the rally on 14. And that's exactly what's happening. That's why there's a tail on 14, and that's why they're selling on 15. It's because bulls who bought here, disappointed here, are exiting around break even, and that's causing this. Another bull bar on 16, but at this point, this is a tight trading range and probably a final flag. So bulls are trying to get a breakout of what's likely a final flag, and they're failing. So I think it's an okay sell below 17 for a lot of reasons. I think the big one is you got to look at the context of the past couple of days. You have a bull trend line and then a trend line break and a higher high attempt here. You have so it's a potential higher high major trend reversal below 17. And major trend reversals, trend reversals. I just put MTRs. I think I just write MTRs. Trend line break MTRs. Here we go. Major trend reversals, usually when you get a higher high, I think this is the only example I actually have. Is this one another example? Okay, so these are 2 examples. So when you get the higher high, you can see here, higher high, major trend reversal, and then you usually get a lower high before you get the swing down. Here as well, you get a trend line break, and then you get a lower high. Well, this was a lower high major trend reversal, so it's not as good of an example. Some would argue that the trend line here was pretty steep up to here, and then you get the trend line break, higher high, and then lower high. But it doesn't really matter how you look at it, as long as you know what's about to happen. But my point being, a lot of times you are going to get a higher high major trend reversal and then some sort of lower high after you get the higher high. And additionally, 90% chance we break out of the 18 bar range So it's possible that when we start to get follow through here, we start, and as we get closer to this low, it becomes more and more likely we're going to get to this low. So I think 17, a reasonable swing trade. Kind of bad follow through on 18, but a lot of traders will stay short. If it's a swing trade, a lot of times it's going to go a little more sideways first before it goes your way. And this is a good example of getting two dojis directly after your trade. 19, big doji bar as well. And then you get 20. Some would argue that the pullback here makes 20 this is the lower high essentially because of this pullback. And so some traders will sell below 20 for a swing on the same premise of 17. It's just a lower entry. And realistically, if we start to get a bounce, most of those traders are going to exit pretty quickly. And that's one of the reasons why we get follow through on 21 and 22 is because bears are selling knowing that if we start to get a rally or a bull bar closing near tie, all the bears are going to exit. It could also be 1, pullback, 2. So there's potential that 20, 21, even 22 is a second leg trap. And so that's the problem with the trade, but it's a reasonable trade. There's problems with every trade, and you have to, it's frustrating, but you have to see the problems with every single trade because there's always two sides, right? In order for you to be able to sell one contract, there has to be a trader willing to buy one contract. And usually the trader on the other side is an institution, and institutions have profitable algorithms. So you need to understand what their side of the trade is. If you're willing to sell below 20, why would an institution buy below 20? And the reason they would is because sometimes this is a second leg trap and they're going to get a reversal up and maybe a test of this high. So that's why an institution would buy below 20. So whenever I say, XYZ is the problem with the trade, what I'm really saying is this is why someone might take the other side of your trade. 21, some follow through, 22, some follow through, and a big breakout on 23, confirming that the bears were correct. Generally, any limit order bulls who are buying in here, hoping it's a second leg trap, are not happy with 21 and are very disappointed that 22 was a bear bar closing near its low, and they're going to sell to their longs, and that's causing the big bar on 23. And then you get an inside bar on 24. I think some bears will sell below 24, thinking that we're probably going to get a vacuum test of the low of the day, because 90% chance we break out of the 18 bar range. And at this point, it's probably going to be the downside. So some traders will sell below 24 and you get bad follow through on 25. When you get the bad follow through on 25, it makes traders think that this low might not be as high probability as they were hoping. I don't know if they got 1-to-1 of their true risk. Not quite, 1 tick away. Well, ended up getting there. But so 27, 26, potential second leg trap, or potential 1, pullback 2, pullback 3. So potentially 3 legs down in a trading range. So a lot of traders buying back shorts, causing 27. It's a potential wedge bottom, but big tail. So bad follow through, likely on 28. And you get traders tried to test that low, but essentially any bears who were holding were scalping out of their shorts. And bulls were buying this low, hoping that they were going to be able to get a good bull reversal bar and potentially a swing up and break out to the upside of the 18 bar range. A lot of times when you get reversals near the high or the low of the day, when you haven't broken out of the 18 bar range yet, sometimes you do get moves like that are pretty violent to the side of the range. So 29, it gives those bulls hope. Generally, they wanted to buy, they wanted this bar to close on its high, but it's still an okay enough bar that a lot of traders who bought above 29 or who bought during 29, will hold on the follow through on 30. But if you buy above 29, you want 30 to be a bar like 8. You want a big bull trend bar closing near its high, telling you that we're probably forcing bears to cover shorts as we rally. 30 has a big tail on the bottom, and that indicates uncertainty. And you have all 1 tail, 2 tail, up, down. So it could be 3 pushes up. So I think better, and that's why a lot of traders are scalping out as 31 goes higher. It's also a test of the 22 close where traders bought below and ended up getting trapped. What I'm saying is it's that vacuum test, and with these tails, these traders are concerned, so they're going to get out probably below 31, fearing that we might end up getting down here, because if we were going to get a strong rally, it probably would already be going. 32, tails on the bottoms, and it could be 1, pullback 2, pullback 3, down on 33, and it's a micro wedge, essentially. So if you're selling 33, there's a lot of issues with selling 33. You're selling the bottom of a trading range, the bottom of a potential wedge, and maybe a nested wedge in there as well. So a lot of issues with selling 33. However, it's an inside bar, 90% chance of breaking out of the 18 bar range. So it's possible we get vacuumed down to here. And if we get vacuumed down to here, maybe we're going to get a measured move down to the opening range, like I already covered. So it's an okay swing sell below 33. But the thing is, if you get any sort of bull bar, you just need to get out. If you're selling a bar like 33, you need immediate follow through. Like that's pretty much exactly as good as 34 was. And you get it. So some traders will sell below 33. Some traders will sell the breakout. Some traders will sell below 34, closing strongly near its low. And you get more strong follow through on 35. 36, I think we're trying to test this high at this point. That would be, what I would be looking for. And obviously the measured move down. 36 kind of bad follow through. It does, after you get super strong bars, and considering that this whole big thing could be a one pullback two, like one pullback, like two, that we're probably going to get, again, at the time, you don't know where this is going to go. But when you're down here and starting to find support, you should start to consider, a one pullback two, a measured move down, something along those lines. So bad follow through 36 and doji bar 37, doji bar 38. When you get a doji bar and a sell to close trend, there's typically going to be some sort of minor reversal or pullback within, 3 bars. And pretty much exactly what happens here. You get good follow through on 39, 40, and 41. The bars aren't as big as these, so it looks like spike, pullback, channel on a smaller time frame. It's a spike and channel trend. And you get a big reversal up on 42. 42 is a big enough bar that any always in bears clearly need to exit above 42. However, this is a pretty strong move down, so we're probably going to get another leg. I think you can buy above 42. It's potentially consecutive sell climaxes, some sort of second leg trap, and it's a double bottom with basically, yesterday's close. But if you're going to buy above 42, you need to be willing to sit through a pullback. You probably just need to put your stop down here and walk away for a little while, because the reality is it's probably going to pull back before it rallies. And you can see you get follow through on 43 and 44, but there are tails on the top because a lot of bulls are uncertain. And if you're going to take a swing trade, you're probably going to be sitting in, quite a bit of uncertainty for a little while. So you get uncertain follow through on 43, uncertain follow through on 44 with the tails, and 45 is a combination of things. A lot of bears, they see the 3 straight bull bars. They know we're probably going to end up, forming some sort of reversal, but they also know this is strong enough for a second leg down. So bears will be selling these closes, hoping for the second leg. Bulls see these bars and are disappointed, and they're going to sell out of their longs, maybe on the close of 44, causing the drawdown on 45. But bulls are ready to buy at, I don't know, maybe 50% pullback or something, or maybe the 41 high where bears should be buying back shorts. Either way, you end up starting to get a rally. And I think that 46 is a much better buy, because what bears will see is one pullback two and a second leg trap. And they're hoping that we continue to sell off straight down, but we're probably not going to. This is pretty oversold. And with all the strong bull bars early in the day, you have to keep that in mind. Like I think I said yesterday, when you get why are there so many strong bear bars? If this is such a good bull trend, why are there strong bear bars? Why is there a big sell-off in the beginning of the day? No. And it's the same concept here. If this bear trend is so strong, if this has all been so strong, why are there 4 straight bull closes here? Why are there 3 straight bull closes here? Why are these bull bars in the beginning of the day great, humongous bull bars? Why is that happening? And that's got to make you think we might be trying to, might be a trading range day. And when it's a trading range day, the open of the day is pretty much always a big magnet. And so you can see that traders are willing to buy above 46, and they got follow through on 47 and 48. Some traders selling above 46, they'd be selling because they're hoping that it turns into a second leg trap, like I said, but it's not very likely. You get follow through on 47 and 48. Could be 2 legs up, but pretty good bull bars, okay to be long. And reversal down on 49. It's a low too short attempt by the bears, but with how steep this bull channel is, we're probably going to get a second leg up for the bulls. Bad follow through on 50, probably sellers above, probably buyers below. And you can see 51. And 51, so bad follow through for bulls buying above this high one. That once we get back to this low, bears are probably going to buy back shorts, and that's what was happening here. But essentially this whole thing right here, it's a tight trading range. And what is the tight trading range trying to do? Generally, when you get a tight trading range, there's a 50% chance the first breakout fails. And a 50%, and it's becoming relatively 50-50. It means the market's pretty neutral. And so you got to look at this and think, well, it's a couple pushes up. And some traders would think it's a couple legs up. We're probably going to get another leg up since this is pretty tight channel. Other traders think this is an attempt at a bear flag. And when you get an attempt at a bear flag, if you get a breakout above the bull flag, you need to be looking to buy. And if you get a failed breakout above the bull flag and then a breakout down, you need to be looking to sell. Sorry, this is a bear flag. Traders look at this thing, it's a bear flag. And when you get a bull breakout above a bear flag, you have to be looking to buy. And we essentially get that. Bears, they tried to break out on 54, failed breakout. Bulls obviously aren't going to buy above 54. It's bad follow through. It's a bad bar to buy. It's obviously bear bar. 56, you can see it broke out one tick above 49 and reversed. Bad follow through. 57, inside bar, doji bar, but probably, if you don't want to buy above a doji in a tight trading range, I think I'd personally rather wait. Some would argue it's a two-legged correction and we're going to rally, but I just don't think that that's all that great. I'd rather buy above a bull bar closing near its high. If we're going to rally, we're going to get bull bars, so there's not really a rush. Bad follow through on 57. As we traded down, bulls were buying, hoping we're going to get a good bull close, and we get the good bull close on 59. If you buy above 59, you are buying right at the open of a trading range day, and you're buying a breakout of a tight trading range. So, it's a risky move to buy above 59, I think. But it's a swing trade. It's not supposed to be high probability. When you're buying swing trades, there's going to be a lot of problems with them because swing trades are low probability, which means they probably won't work. So there are going to be more problems than there are benefits with a lot of these trades. But if you're buying, you're hoping you're going to get essentially a measured move up of that, which is pretty much right where we stalled. And, you're risking a little over 5 points, 5.5 points to make 15 points. So you're getting about roughly 3-1 on a swing trade at 40%. That's a pretty good trade. Bulls get follow through on 60. If you're buying above 59, you want good follow through fast, and they get it on 60. And then you start to get race up on 61, and a lot of those traders, pretty quickly got not quite 10 points, but they've pretty quickly made. I think they were 2 ticks short of getting 10 points because what's this high? 62. So we need to get 72, 75. And we got to 72. So a couple ticks shy of making 10 points. But a lot of traders ended up just taking the scalp as we broke out above this high. And that's why you get a doji on 62. Again, just like the only magnet of the day is this high. And this was probably trying to create a big bull bar, and we're going to get big follow through up to the high. But the reality is, what ended up happening was bulls just ended up scalping out of it because, it just wasn't that good. And when bulls start to scalp out, traders begin to wonder, well, why aren't we racing up anymore? If it's so, it's kind of the same thing as here. If you're selling below 24 and it's such an obvious magnet below here, we should just go down to it immediately. And if you're buying above, 60, it's not that clear that we're going up here. But if 61 starts to race up and close on near its high up here, you got to be thinking, well, we're probably getting to the high of the day at this point. But it tries to do that and fails, so it makes you less certain that we're going up to that high. We didn't end up doing it, which was pretty interesting. But yeah, as I was saying, 63 high one buy above 62. It's okay to be long, but is this the follow through you're looking for? What's your goal if you're long, really, at this point? Like, what's your goal? We're pretty deep in a bull trend. We're at 42 to 63, so we're 20 plus bars into a bull trend. You just had a pretty climactic bar, and it's a trading range day, so the open of the day is going to be a magnet. So I don't know exactly, what you're hoping to accomplish being long above 63, being long in this area. You might get a breakout, but I'd rather wait for consecutive bull bars. If 64 is a bull bar closing on its high, then maybe you can buy hoping to get up here. But I'd rather wait for more follow through. Sure enough, failed breakout 64, and then it trades below 64 on 65, making this potentially 2 legs up. And that's why I get bad follow through on 66. 66 to 68 might be 2 legs down, and I think bulls have to exit. Side note, if you bought above 65, disappointed 66, exiting around break even during 67. But 68 closes near its low. Bulls have to exit below 68. I think any always in bulls will exit, and bears would be hoping to sell to get a quick scalp down to the open of the day. But you can see bulls bought the close, and they never let it trigger. And some bulls would be buying 69 as it races up, hoping that, bulls are getting trapped out because they'll exit, as this bar is going down, or they exit below here or below here, or their stops are below 65. So they're hoping bulls are trapped out and bears are trapped in, and that we're going to start to rally. And if we get a big bull bar closing near its high, it's another breakout of potential bear flag. It's just a channel at this point, but that's what they're hoping. And you end up getting some follow through on 70 to the top of the channel line, but there's a big tail on 69, a big tail on 70, so it could be 1 pullback 2, and then pullback 3 on 71. And if this is so bullish and we're probably going to the high, why are there big tails on all these bars? Why is it going very sideways? And so what ends up happening is bulls start to get disappointed with the tails and they start scalping out, causing these reversals. The daily chart, obviously the market made a big tail in the last couple. I don't know if it happened on SPY, did it? Or was it the first after hours bar? Well, that's interesting. But sorry, just want to look at that. On the daily chart, it's a pullback. You can see, I actually mentioned yesterday afternoon in my review, there's a chance that the bears who sold below here were going to be disappointed in this, and they were going to buy back their shorts and cause a rally. And you can see the bears who sold here were disappointed in this, and when we tested their entry price again, right, because they were hoping for more big bear follow through, and they don't get it. So it tests around their entry price again, and those bears are buying back shorts. So bears buying back shorts is causing this rally. I think obviously this is strong enough for a second leg down. And we'll see when we get it. We might rally a little bit more to the moving average, but pay a lot of attention to the strength of this rally, how strong the bars close, how many bars it lasts, because it will, be a factor in, how much lower we end up going on this second leg. Additionally, it could be 1 pullback 2, pullback 3, so consecutive sell climaxes. So we could end up getting some sort of rally, but overall, just expecting sideways. In fact, weekly chart expecting to get back to this low. Probably disappointing follow through for the bears who sold below that week. Yeah, that's today.